Well, hello, and welcome back to Principles of Accounting 2. I'm your host, Dr. B, and today we're going to be talking about how to analyze financial statements. This chapter really is a bridge between Principles of Accounting 1 and Principles of Accounting 2. And the reason why I consider this to be a bridge is because we'll look at the financial statements, income statement, balance sheet, statement of cash flows, retained earnings, things like that. And we'll talk about how managers analyze the information presented on the financial statements. And that's why I consider this chapter to be a bridge between Principles 1 and Principles 2. So we'll talk about how the information is presented and how to analyze that financial information. And we'll talk about the primary ways that they're analyzed. So when we talk about analyzing information, what we're doing is we're talking about how managers interpret the financial data that is presented to them. And that's what analysis is all about. We look at it in a few different ways, right? As a manager, I'm interested in where I am today, how I got here, past, and where I'm going, the future. Okay? So I'm interested where I am today, current, how I got here, past performance, and where I'm going, future performance. That's, as a manager, that's what I'm interested in, okay? How I got where I am today from performance. What happened? How did I get here? Past performance. I analyze the current situation. Okay, I look at my current income statement, balance sheet, statement of cash flows. I compare my income statement, balance sheet, statement of cash flows to the past. So here we are, 2022 March. At the end of this month, I'm going to look at my income statement. I'm going to look at my balance sheet and my statement of cash flows. And I'm going to compare that to March of 2021. And I'm also going to compare that to March of 2020. So I'll say, here I am, March 2022. At the end of this month, I'm going to look at income statement, balance sheet, statement of cash flows. I'm going to compare that March of 2021 and to March of 2020. What that's doing is it's showing me the past and how I'm performing currently in relationship to the past. Did I get better? Did I get worse? That's how I look at my current financial position. I say, is it better or is it worse? Did my income go up or did it go down? Did my expenses go up or did they go down? What happened to my cash flow? What happened to my balances? That's the importance of analyzing the financial data. I look at my current position. How did I get here? I compare my current position to my past performance. And then I look to the future by forecasting. I say, where do I want to be in a year from now? And what are the risks associated with those? In 201, we talked a lot about external users, stakeholders, lenders, suppliers, the government, people outside the company. Okay, people on the outside of the company, those are external stakeholders, external users of information. Your customers, people outside the company. Yeah, that's external users. In managerial accounting principles 2, I'm concerned about my internal users of information, the managers, the owners, the officers, the internal auditors. These are people inside the company. That's what I'm concerned about in managerial accounting principles too. I look at my financial statements as a manager, and I try my best to understand how liquid my assets are, how efficiently I'm using my assets to generate revenue. That's a very big concern of mine as a manager. For example, if I need to make a large purchase, oh, I need to purchase a piece of machinery, okay? A piece of machinery that will help me to manufacture some more inventory efficiently. Okay. So I need to purchase some inventory or a piece of machinery to help me to create inventory products. And so where's the cash going to come from? That's why it's important that I understand what my company's liquidity is. Liquidity means, in case you forgot, liquidity means how quickly I can convert assets into cash. Liquidity. How quickly I can convert assets into cash. And I'll use that cash to buy that piece of machinery. So that's an example. But liquidity means how quickly I convert things into cash. Efficiency is how efficient am I at using my assets to generate revenue. As a manager, I'm also very concerned about solvency. The word solvent, what does it mean? Can anyone tell me? What is solvency? What does it mean to be solvent? Do you remember? What does it mean to be solvent? Any thoughts? What is solvency? What does that mean? Don't all shout it out at once now. What do y'all think? What does it mean to be solvent? Come on. I know you know the answer.
To be able to pay your debt back.
Sheila, yes. Yes. You're right. Do I have the ability to pay all my debts? Solvent. Think of water, okay? Water. Water is liquid, right? I think so. Water is liquid. If I put an Alka-Seltzer tablet in this water, it will dissolve, right? It'll disappear. Yeah? It'll fizzle up and it'll turn into nothing, right? That's what it means to dissolve. Solvent is very similar in nature. Think of the Alka-Seltzer tablet as debt, okay? And the liquid is cash. See what I did there? Liquid is cash. So I put the tablet in the water and it dissolves. Okay? That's solvency. That is what solvent means. Solvency, as Alicia said, is the ability to pay the debt. Solvency means the company can pay all its debts, short-term and long-term, and be able to go out of business. That's what solvent means. I can cover all my debts and go out of business. That's solvency. Ability to pay all your debts. Yes, 100%. Thank you. As Mary, yeah, ability to solve the debt problem, yes. To pay all the debts. That's solvent. Profitability. You guys know what profitability is. As a manager, you're very concerned about being profitable. You don't go in business to not make a profit. All right. Do you think Christian started the clothing line business to not be profitable? Oh, come on. His whole goal is to make a profit. That's why he went into business. You don't go into business to not make a profit. You go into business for profit, right? That's the whole idea. So profitability as a manager, one thing that Christian does is he looks at his raw materials, okay? The clothing that he acquired, okay? The blank shirts and hoodies and sweaters and all that good stuff he got, okay? So that's we call that we'll call it raw materials, okay? And so they're blank. They're the blank shirts and hoodies and all that jazz, okay? Because remember, he's got the screen printing business, yeah. So and he's going to put his logo and all this great stuff and awesome words. And Christian, what kind of designs you got on your the stuff you make?
It varies. I use letters on some hoodies only. Then on some others I'll use like a planet, things of that sort.
Cool, very cool. So as you're doing that, you're screen printing on the raw materials, which are the shirts that you get, the clothing that you got that's blank already, right? And so the way we think about your businesses being profitable is you're selling that clothing that you customize to your customers above the cost, above the cost of acquiring your raw materials, above the cost of the ink and the other material that you're adding to the raw materials, above the cost of your labor, your hourly labor that costs to make each product, and your overhead for each product. So, like in manufacturing, we have direct materials, direct labor, and factory overhead. And throughout the next 8 weeks, you're going to hear me talk a lot about those three things: direct materials, direct labor, and factory overhead. Direct materials is the labor of the employees that are making the products. Okay. Direct materials is the raw materials, like the clothing, right? The blank clothing. The direct labor is the labor of the employees working directly on the product, and the factory overhead, that is like the space that you're doing it in. Like if you're doing it in a garage, it's the space of the garage. It is the depreciation of the screen machine. It is a little bit of the electricity that you're using to operate the machine, things like that. Okay, that's all overhead. So we take those three things, and so we add those together for each piece of clothing, right? That's your cost of the clothing, okay, your total cost of the clothing. We sell above the cost. The sale price minus the total cost, that's your profit. That's your gross profit. Remember, on the income statement, we have this thing called revenue minus cost of goods sold equals gross profit minus expenses equals net income. The gross profit part is what we're looking at in profitability. So as a manager, for Christian as a business owner, we're looking at what is my profitability for each product and for the company as a whole. So that's what we mean by profit. There's a couple ways we'll analyze it. And then the last thing we do as managers, we look at things called market prospects. What is my ability to sell this clothing line? Or if I go public, what is my stock opportunities? Things like that, right? So many different things are within market. Those are the four things as a manager or as a business owner we look at as when we're analyzing our financial statements. So the first thing we do is gather information. we take our most recent income statement, balance sheet, statement of equity, statement of cash flows, any notes, gather all of that information together, and then begin the analysis process. When we're analyzing, one of the important things we need to understand is, what is the standard? What is the industry standard? Well, we say industry standard. What am I comparing it to? Right? So let's say Christian's business is brand new. Okay. What are we going to compare the performance of the business to if it's brand new? It's like, oh, well, I need to benchmark it to something. So I would benchmark the business's performance to the industry or to the competitors or to a sister company or to guidelines established for the industry. I don't know. But we look at ways to benchmark our performance. We call these standards. Standards are the what our competitors, industry guidelines, other companies say is what we need to, where we need to be at. So, for example, in the apparel industry, we could say that the current ratio average for the industry is 1.2 or whatever. Okay, so that what we'll do is we'll look at our current assets and our current liabilities and see if our company's average is close to the industry average. That means we've met standard. It's the idea of, we need to compare our performance to something through benchmarking. There's a couple of different ways we could do that. Just a little hint for your homework assignment with respect to the discussion that is due Sunday night. We're asking you to compare horizontal analysis to vertical analysis. So this point forward will be very important for you to pay attention to. Just a little side. So as we're looking at our standards and we're looking at our business performance, we're going to use a couple of different tools to analyze that information. One tool is called horizontal analysis. This is where I'm comparing my company's performance over the horizon line, over time, the horizon line, right? I'm looking at, and I started earlier with an example. At the end of this month, I'm going to compare my business's performance. So March 2022, I'm going to compare that to March 2021 and then to March 2020. I'm looking at my performance over those 3 years, right? For that month. That's called a horizontal analysis. I'm looking at the change over time. I'm looking at the dollar amount difference, and I'm looking at the percentage change over time. The dollar amount and the percentage. Dollar amount, percentage. So for example, 2022 March, my sales were 100,000. Okay. March 2021, my sales were 80,000. Well, I know what the dollar amount difference is. It's 20,000. What's the percentage difference? Well, I would use the current year over the base year. So current year, 100,000, base year, 80,000. So my difference is 20%. So I could find the difference in percentage and dollar amount. That's the type of information I'm looking for in a horizontal analysis. And I'll do that from year to year. So 2022 compared to 2021, 2021 compared to 2020. As I'm looking at those differences, I can start to see a trend, right? As a manager, that's super important. So if Christian's like, man, I'd really like to know how I'm performing in comparison to last year, that's how you do it. That's how you do it. It's through horizontal analysis. You could also do it through vertical analysis. In vertical analysis, we're comparing the financial condition and a performance to a base amount. That's cute. Vertical analysis is up and down. Horizontal is left and right. Okay? Horizontal means cross time. Vertical means I'm comparing it on the same financial statement up and down. For example, on the income statement, we have revenue, cost of goods sold, expenses, net profit, or net income. On the income statement, I compare everything on the income statement as a percentage of total revenue. On the income statement, I compare everything as a percentage of total revenue for the vertical analysis. So I'll say total revenue, 100%, and then I'll express everything as percentages of total revenue in order to compare the financial condition to that total revenue. What that does is it tells me what percentage my utility expense is to total revenue. So in other words, how much of my total revenue are my utility bills taking up for each month? That's a nice way of being able to tell that type of information. That's what vertical analysis tells us. So vertical analysis on the income statement is expressed as a percentage of total revenue. On the balance sheet, everything is expressed as a percentage of total assets. Okay. On the statement of cash flows, it's different. Everything's expressed as a percentage of total revenue. And those are really the only three that we do vertical analysis for. Vertical analysis is best used for the income statement and the balance sheet. And then one other tool that we might use to analyze our financial statements is called ratios. You all remember those, right? I know that some of you prefer not to remember how often we use ratios in accounting. But ratios they provide us with relevant information. They identify the relationship between certain items on our financial statement. As a manager, it's good to know what my ratio is because I can benchmark it to the industry. Earlier, I gave the example of the current ratio. That's current assets divided by current liabilities. That tells me my company's ability to pay my current liabilities. What is my ability to pay my current debt? Current ratio, right? Current assets divided by current liabilities. That I can benchmark that to the industry average. So that's one of the many uses of ratio. But these are the three primary ways we analyze financial information. There's a couple of others, but these are the three most important. So the horizontal analysis, as I said earlier, looks at the financial performance over time. I'm comparing year to year, month to month, to better understand what the trends are over time. Are my sales going up? Are they going down? Are my expenses going up, going down? What about my balances? And so what I do is I look at the differences from year to year or month to month. I'll say, okay, so the change is this dollar amount from month to month. The change is this percentage from month to month. That gives me a really good idea of the change over time. So first thing we do is we take a look at the change in the dollar amount. So March 2022, my sales were 100,000. So that's the analysis period amount, 100,000. Minus the base amount. The base amount is typically always the previous accounting period. So if I'm comparing it to last year, I'm going to look at March 2021. So March 2022 was 100,000. March 2021 was 80,000. So my difference, dollar change, is 20,000. This is the formula for it. How do I find dollar change? Current year minus previous year. Or if you're doing it monthly, it's the same concept. Current minus the previous. That'll give me my dollar change. And I also need to find my percent change. Current year minus the previous year divided by the previous year, technically times 100, gets you the percent change. That's how you find percent change. This is the formula to find percent change. You may have seen this also in a statistics class if you've taken stats. Was it stats 200? This is what it looks like. So in this example, this is the balance sheet. The balance sheet, I see my current year minus my prior year gets me my dollar change. My current year minus the prior year divided by the prior year gives me my percent change. And I want to do that for every line item on the income statement and the balance sheet. And what that does is it tells me the trend. It shows me the trend. Like, for example, here I can see, oh, my total assets went up by 53,000, which is a 16.7% increase. That's good. That's good. I think that's good. What happened to my liabilities? Well, my liabilities also went up. 47,835. It's a 24% increase. Well, you know, I'm sure there's a reason for that. And so that's why understanding the dollar change and percent change through horizontal analysis is so important, because we look at the dollar change and the percent change over time. And I do the current year minus the previous year. I could also look at the year before and do the same thing, right? And it shows me the trend over time. That's why it's so useful. That's what I like most about horizontal analysis.
Professor?
Yes,
I'm sorry. Can you go back to the slide where it said percent change? I was almost finished writing the formula down.
Hey, no worries. Yep. So percent change is the current year minus the previous year divided by the previous year times 100.
Thank you.
You're very welcome. Yeah. Knowing the formulas, definitely. Yes, please remember the formulas. Because that'll really help you when it comes to computing things like horizontal analysis. So we looked at the balance sheet. Here's the income statement. Again, we do the same thing. Current year minus the prior year gets me the dollar change. To find the percent change, I take the current year minus the prior year divided by the prior year. That gets times 100 gives me percent change. And I look at all my line items for this. And again, one of the most important reasons for this is to identify the trends. Identify the trends. It's like, oh, my sales went up. Great. Oh, my expenses went up. Not so great. It's like, it's important to understand those changes. Because as managers, we need to know what changed, why did it change, and how can we control it in the future. We call it trend analysis. Right, we're looking at the patterns, right? That's what it's all about. And in trend analysis, I can look at the percent change over multiple years. And I'll analyze each period. So with the analysis period amount, current year, divided by the prior year times 100. Current year divided by prior year times 100 will give me my trend percentage. Trend percentage. And the percent.
Wait, I'm sorry, Professor.
It's all right. It's okay. I got you. Current year divided by prior year times 100. Current year divided by prior year times 100. We call that trend percentage. And the trend percentage is useful for identifying patterns across multiple time periods.
Gotcha. I'm sorry. I'm sorry.
That's
I'm working on
okay.
it.
No worries. No worries. I got you.
Professor, I had a quick question.
Yes,
Sorry.
ma'am.
In the percent change, the base year would be the prior year.
That's correct. The base year is the prior year. You got it. Yeah.
Thank you.
You're very welcome. In the trend analysis, it's really helpful for recognizing the change over multiple periods. So when you think of horizontal analysis, think current year and prior year. When you think about trends, think multiple years. Trend percentage is good for multiple years. Trend percentage is good for multiple years. Horizontal analysis is good for the current year and the prior year. Make sense? That's the best way to think about it. So when you hear trend, think multiple years. When you think horizontal, it's the current year and a prior year. The reason why we look at trends is, again, to identify the changes over multiple years. And in this example, we're looking at things like net sales, cost of sales, operating expenses, and we can see the trends by using the percentages. If it's multiple, I should also say this. If it's multiple years, like for example, in this example, we have 5 years of data. Okay? 5 years of data. And in this example, with 5 years of data, my base year is the oldest year. My base year is the oldest year when it comes to trend analysis. Base year is the oldest year for trend analysis. The base year for horizontal analysis is the prior. We can express these changes, these trends, through graphs. The line graph is probably the most useful in business because it visually shows me the trends over several years. Personally, I like the line graph. Questions on horizontal analysis before we move into vertical analysis?
Yes. Can you go back one more slide just for 5 more seconds, please?
Yeah, of course I can.
No, forward
This
one.
This one?
Yes.
The line graph? Yeah, it just kind of shows us the importance of the line graph. So what we're looking at here is the trends expressed visually over time.
Gotcha.
Cool.
Thank you.
You're welcome. Okay, let's talk about vertical analysis. So we talked about horizontal, which is we're looking at time across the horizon. Okay, where I'm comparing the current year to previous years. That's what horizontal analysis is. And I'm looking at the percent change and the dollar change, year to year. That's horizontal. Vertical, I am looking at each financial statement expressed in percentages as a percentage of something. On the income statement, it's a percentage of total revenue. On the balance sheet, it's a percentage of total assets. And I express everything on those respective statements as a percentage of. So let me show you how that works. Formula. The formula works like this. I take the amount that I'm analyzing divided by the base amount times 100. I take the amount that I'm analyzing divided by the base amount times 100. I take the amount that I'm analyzing divided by the base amount times 100. We call this common size financial statements. And what this does is it expresses each amount as a percentage. On the balance sheet, everything is expressed as a percentage of total assets. On the income statement, everything is expressed as a percentage of total revenue. I'm going to show you what this looks like. Here's a balance sheet. This is Apple. So here's Apple's balance sheet. We have current year and prior year. And everything is expressed as a percentage of total assets. For example, I come up to inventory. Let's say I want to analyze my inventory. I want to say, hey, what is the percentage of my total assets for inventory? So the way it works is I take the analyzed amount divided by the base amount times 100. So I go 4,885 inventory current year divided by the base amount 375,319 total assets. Remember, total assets is always going to be the base for the balance sheet. Total assets is always going to be the base for the balance sheet. So I take inventory divided by total assets, and I get 1.3%. Inventory divided by total assets, well, times 100, to get 1.3%. And I do that for every single line item on the balance sheet. Now you might be asking yourself, how do I know if I'm correct when I do this? When I go, okay, I'm trying to find all the percentages for each line item, how do I know I'm correct? There's two for sure ways. Number one, use Excel because that's the easiest. But there's two sure ways. Okay. When you get to total assets, it's 100%. Total assets divided by total assets is 100%, right? The other way of making sure that it's correct is that, remember the accounting equation? You guys remember this, right? Assets equals liabilities plus equity. That's the accounting equation, right? Assets equals liabilities plus equity. According to the accounting equation, my assets, total assets, equals total liabilities plus total equity, which it does. Total liabilities, 64.3%. Total equity, 35.7%. Well, that equals 100. So total assets equals total liabilities plus total equity. 100% is 100%. The accounting equation is always going to be in balance. So that is a surefire way for you to know that you've computed the vertical analysis correctly for the balance sheet.
I have a quick question.
Esmeralda, please.
Okay, so just making sure the vertical analysis will always be like one line item in the same category for the same year and then divided by the total for that same section.
Yeah, so let's walk through that together. So the way it works is that we take the amount that we're analyzing for the current year divided by the total assets for that current year times 100. If I'm analyzing the prior year, it's the prior year analysis amount, for that line item, divided by the prior year total assets times 100.
Okay.
So I think the answer to your question is yes.
Okay.
Cool. Good question. So that's the balance sheet. On the income statement, this is Apple's income statement, current year, prior year. On the income statement, we express everything as a percentage of total revenue. On the income statement, we express everything as a percentage of total revenue. At the very top, we have net sales. Remember, sales is revenue. That's what revenue is. Revenue is sales. Sales is revenue. So net sales, call it net revenue. Current year, 229, 234. Divided by the base. The base is total revenue, 229, 234. Times 100, that's 100%. So then we go down each line item. We take the analyzed amount divided by the base, total revenue, in this case, net sales. For example, total operating expenses, $26,842, divided by the base, total revenue, $229,234, times 100 equals 11.7%. I do that for all my line items. I do it for the current year, and I do it again for the prior. The amounts must remain in those years when you're doing this analysis. So the net sales for the current year is your base for the current year. The net sales for the prior year is your base for the prior year. Make sense? Yeah, good.
Yeah.
Cool, thank you. We can express that graphically as well. This is a pie chart. Pie charts are nice because for percentages, pie charts are really nice. I can see very visually the percentage of what makes up my income statement. Right? That's nice. I like that. Nice quick way to get an idea of percentage. I like it. So we talked about horizontal analysis. We talked about vertical analysis, which, by the way, as a reminder, the discussion board that's due this Sunday night, that's worth 10% of your total grade, what we just talked about, horizontal analysis, vertical analysis, you're going to compare those two and discuss them. I want you to use outside resources, websites. Make sure they're credible. Don't give me no Wikipedia stuff. Use some websites. You can use your book. That's fine. You can even use this discussion. That's fine too. You'll write a paragraph or so, 4, 5, 6 sentences. Citations, references. And then you'll respond to 2 or more of your classmates with full paragraphs. That's the discussion board assignment that's due this Sunday night. Use all the stuff we just talked about to complete that assignment. Now let's talk about ratios. I know you guys love ratios so much. There are four categories of ratios that we talked about earlier: liquidity and efficiency, solvency, profitability, and market perspectives. The liquidity is how quickly I can convert things into cash. That's what liquidity means. Liquid. Liquid. Yeah, how quickly I can convert things into cash. Efficiency is how efficient is my business at generating revenue? How well am I using my assets to generate revenue? That's what efficiency means. Here are 7 ratios that I can compute for liquidity and efficiency purposes. And we've talked about these 7 before, and I'm pretty sure there's a really great page in the book that has all of these ratios listed out very easily. It's like a quick reference for ratios. Additionally, the business should know, any good manager should know how to find working capital. Working capital is the capital that we have remaining after we've taken out our current liabilities. It means working capital. It means I can use this capital to invest into the business. Call that working capital. Very simple calculations, just current assets minus current liabilities equals working capital. Current assets minus current liabilities equals working capital. And again, working capital is what we can use to invest back into the business. That's why we call it working capital. That's a very important thing for any business owner or manager to understand, because we need to know what we can invest back into the business to grow the business. Working capital. That's why it's important. Current ratio, we talked about this one. Current assets divided by current liabilities. This represents the company's ability to pay its current debt. Can the company pay its current debt? I hope so. So if it can, it's going to be 1 or above. If it cannot, it'll be below 1. Similarly to the current ratio, we can compute what's called the acid test ratio. It shows me how easy or difficult it is for the company to convert their assets into cash. This is also called quick. On the top line, we have cash plus short-term investments plus current receivables. We also call these quick assets. How quickly I can convert those into cash plus cash. Divided by current liabilities gives me the acid test ratio. Account receivable turnover. This tells me how many times a company has the ability to convert its receivables into cash. Remember, accounts receivable is what your customers owe to your business. So your customers purchased your stuff on account. It means they haven't paid you yet. They'll pay you later. So it generates what they call an account receivable. You expect to collect that account receivable. So to figure out how many times you'll be able to collect that account receivable, we take the net sales divided by the average accounts receivable. To find the average accounts receivable, we take the beginning balance plus the ending balance divided by 2. Inventory turnover. Christian, this one's going to be good for you, I think. Inventory turnover is important because as a manager, you don't want to be, or as a business owner, you don't want to be sitting on a bunch of inventory for a long period of time, because that means your cash is tied up in inventory. Having too much inventory is a bad thing. Okay, not having enough is also a bad thing. So how do we find that balance for inventory? You might look at something called the inventory turnover. It tells you how long your inventory has been sitting there before you sell it. This is a nice ratio. You take your cost of goods sold divided by average inventory. So remember, average, when you hear average, it's the beginning balance plus the ending balance divided by 2. It's a good one. Days sales uncollected. Tells me how quickly the company's collecting on my accounts receivable. I take accounts receivable divided by sales revenue times 365 days. So how long is it sitting out there? How many days is it sitting out there for? Accounts receivable divided by net sales or revenue times 365. Days sales and inventory. This one's good. Tells me how quickly I'm selling through the inventory. Ending inventory divided by cost of goods sold times 365. This one's good. I like this one. This is total asset turnover. Tells me how well I'm using my assets to generate sales. I take my net sales divided by average total assets. Remember, when you hear that word average, beginning balance plus ending balance divided by 2. So those are the liquidity ones. Let's talk about solvency. As we had said earlier, solvency is the company's ability to pay its debt, right? And go out of business, right? That's what it means to be solvent. Pay all the debts. 4 ratios here: debt ratio, equity ratio, debt to equity ratio times interest earned. Debt ratio, this is the thing that banks look at before they decide to issue you a loan. They look at your total liabilities divided by your total equity. It's important for lenders, right? And as a manager, you need to know this, what your debt ratio is, because you just gotta know what your ability to take out additional debt is, or equity for that matter. Debt to equity ratio is also a good one. The banks also look at this. So we take the total liabilities divided by total equity. Also gives an idea of how quickly the company can expand using debt. Times interest earned. This one is also used by banks to see what the company's ability is to pay its interest on the loans. Take income before interest and taxes divided by interest expense. What the heck? It's got weird a bit. What? Okay, that's nice. Go away.
Professor, you're moving way too fast for me.
I'm sorry. I am flying through this.
It's okay. I'm taking pictures. I'm just trying to keep up with my, my writing hand.
You don't have to take pictures. You can download the slides in the classroom.
I'm just working with the flow because, Professor, my schedule is really hectic.
I got you. I understand. I totally understand. I got you. We'll get you through it. Don't worry. I'm going to show you the best slide of all. It has a whole list of them. Times interest earned. Company's ability to pay its interest. And interest before interest and taxes divided by interest expense. The income before interest and taxes is found on the income statement. It's usually toward the bottom. And if it's not there, you can compute it. You take your net income plus interest expense plus income taxes. It's like working backward, right? Profitability ratios. Everyone needs to know how to be profitable. That's why we go into business in the first place. There are 3 primary profitability ratios that I like to calculate. Profit margin, return on total assets, return on common stockholders' equity. Profit margin. Oh, Christian, please tell me you know what your profit margins are on the stuff that you're selling. Very important to know this. Very important. The reason why this is important is because it tells you the amount of profit you receive from each sales dollar. Oh, man, you got to know this. We take the net income divided by net sales. Profit margin, net income divided by net sales. Very straightforward, but very important to understand. And I'll say one more thing about profit margin. This will also, in the future, will also help you to identify what your sales price should be. Yeah, profit margin. So important. Don't worry, we'll talk a lot about that throughout the course. Return on assets. How well is the company using its assets to generate revenue? Another one of those type of ratios. And I like this one. Take net income divided by the average total assets. How do we find average total assets? Take the beginning balance, average total assets, plus the ending balance, average total assets divided by 2. Return on common stockholders' equity. Net income minus preferred dividends divided by average common stockholders' equity. How do we find the average common stockholders' equity? Take the beginning balance plus the ending balance divided by 2. And there's kind of a pattern here. All these ratios, I love them. Company's ability to earn income for common stockholders. This is a nice way to attract new common stockholders to the company. Again, it's for publicly traded companies or for private ones that have common stockholders. Those exist. That's common. Market prospects, 2 ratios. Price earnings ratio, dividend yield. Price earnings ratio is the market expectations for future growth. So I might say, hey, you know what? I'm an investor in Starbucks, and I want to know what is the future growth look like for Starbucks. I could calculate that. I can take the market price per share, common share of stock, divided by the earnings per share. So that's kind of interesting, right? Last one's called dividend yield. Dividend yield is annual cash dividends per share divided by the market share price. This kind of tells me a better way to say this. Dividend yield tells me the company's ability to pay future dividends. What's the company's ability to pay future dividends? That's what dividend yield tells me. Now, Makia, here's the slide you need right here. Slide number 46. The summary of ratios. So all of those ratios we just talked about in one cute little picture. You can study this to your heart's content. Yeah, so this is like a reference slide. I'll say it reference. Yeah, it's a nice
Thank
reference.
you.
You're very welcome, Nakia.
You know I got my picture.
I know you did. Yeah, this is a great slide because it just summarizes all of the ratios we just talked about, and it tells me why. It tells us why for each one. Cool, right? Uh, I look at all of this information as a manager that we talked about. We talked about horizontal analysis, vertical analysis, ratios, and I can put all this great information into reports. As a manager, it helps me because I can have a nice executive summary, look at it as an overview. Why is it important? I can make some assumptions. Like, for example, if I'm looking at my horizontal analysis over time, I can say, hey, what happens if we go up by this percentage or down by this percentage? I can make assumptions, right? Assumptions about the future. I look at key factors, and we also look at a couple of benchmarks or inferences. That's why it's important to do financial statement analysis. I also look at sustainability. What's the company's ability to maintain operations? Or what if I need to discontinue sales of a certain line item that's not performing well? What if there's changes in the accounting principles? How will that affect my net income? And is my earnings per share really sustainable? That's what we call sustainable income. It's able to continue into the future. Now look at the income statement to understand how it's sustainable. I look at the net sales from continuing operations. I look at anything that was discontinued and what was the income or loss from that discontinuing items that didn't sell well. And of course, what is the earnings per share? What does that look like? All of this is about sustainability of the business moving into the future. That, my friends, is our discussion today on analyzing our financial statements. Any questions, comments, concerns? Really? Oh, good.
No, I don't have any questions.
Okay, all right. Okay, I'll take that. Excellent, fantastic. So with that, I want to take you back into the classroom and remind you again how important it is that you complete the homework assignment for this week. So in Module 1, Week 1, we have this thing called the Chapter 17 discussion. With this, you are to compare the differences between vertical and horizontal analysis. Full paragraph responses, please. Feel free to use outside resources. Please include citations and references, especially in that original post. Yeah? And then make sure you respond to 2 of your classmates with full paragraphs. This is worth a total of 10 points. That is a full letter grade for this course. Please make sure you do it. So important that you do it. There are 15 of you in the class. So, yes, very, very important that you please make sure you do this homework assignment. Very important. My recommendation is to use the class time on Wednesday from 5:30 to 8 to jump into this discussion and complete it. That's my recommendation, right? Because remember, we only meet on Mondays from 5:30 to 8 here on WebEx. Our lectures are only on Mondays, 5:30 to 8 on WebEx. The class time reserved for Wednesday, please make sure that you complete your homework assignment for each week on your respective Wednesdays from 5:30 to 8. Feel free to jump into the classroom to do that work. And of course, I'll be around, so You know, if you ever need anything, have questions, I'll be around. So with that, are there any other comments, questions, or concerns? You all know what to do, right? Make sure it's on time. We got to do things on time, yeah? So important to do things on time. There's a lot of stuff going on in this course, so we got to make sure we're on time. Okay. With that, my friends, as a reminder, I want you to please stay safe, wash your hands, and do all the right things. And I'll see you all again next Monday, 5:30. Same time, same channel, all that great stuff. And if you ever need anything in the meanwhile, you can email me, call me, set up office hours. Whatever it takes, I'm here for you 100% of the time. Please stay safe, wash your hands, do the right things. I'll see you all again next time. And thank you all so much for your time today. I appreciate all of you. Thank you so much. Bye-bye.